This really startled me. I knew it was bad. I just didn't realize how bad. I really didn't pay attention. So, I've been crowing about the fact that we are way overpriced. I mean, so far overvalued from reality. Here we are. I'm here in Phoenix, Arizona, probably one of the best markets in the world, just an absolutely outstanding market. And we're overpriced. And we're overpriced because we're in the rental business and we need to get a return on our investments. And if we can't get a return on any investments, the investment is no good to us. So the only way you can reconcile this is to get it at a very good price. Where's that price? I don't know where it's at. So I had to start doing calculations. So let's start this. You're not going to like this. I'm telling you, this may not be definitive, but it really scared me. It really kind of shook me up a little bit when I took a look at this, because this is so reminiscent of the great financial crisis. And I'll explain this to you as we go along here. So let me go to my very first slide. Let's just talk about this so you can see this. Now, there's some things that just fuel the economy. Now, we've been following some cycles. We've been following the real estate cycle. We've been following the interest rate cycle and the liquidity cycle. Now, the liquidity cycle, it finished in really March of 2022. It peaked. Now, you can take a look at this. You can see this. You can see this right here. You can see this little gray shaded area, of course, is the COVID recession, where they just dumped tremendous amount of liquidity. I think this is $5-6 trillion in a month or two. It didn't take very long for this to get up here, and it just was like rocket fuel. And of course, the economy just took off. The market, the market is, so that when you talk about the Dow Jones and the stock market, they're the most liquid markets in the world. That's where the liquidity goes. Immediately, stock market took off. And of course, we followed in the real estate market, and we followed just as well. When it was the accumulation phase, and then the explosive phase as we're coming here. And you can see we peaked, and we just kind of bounced along here. And then they announced that they were removing liquidity from the market, and they started taking it down. And here again in 2022, we started going negative, which has never, ever happened before. So let me go to my next slide here. Now, can you see the bubble here? Liquidity, PPI went up, CPI went up, the price consumer inflator went up. Everything went up right with liquidity. You could just see it. And of course, it's the everything bubble. Absolutely, positively everything bubble. Everywhere you look, there was bubbles. Absolutely everywhere you looked, there were bubbles. Bubbles in the stock market, bubbles in the bond market, bubbles in commodities, and the bubbles coming into real estate. It was absolutely everywhere, and that's an excess. Markets don't like excess, and that's got to be changed. And it's startling. I'm going to tell you. By the way, this is kind of running in the same vein we've had in a lot of our videos. So if you like the videos, I'd say go back and take a look at them. Give me a thumbs up. Like these and subscribe. It really, really helps with YouTube. So let me just get back here. So we start taking a look at this everything bubble. So this everything bubble proceeded, and we started to slow down. Now, if you recall, we had a crisis in the banking, and let me just go to this last file. So once this started happening, when we start getting here to 20 and 2023, liquidity becomes a problem. There's no liquidity around. And of course, this is where we had Credit Suisse Bank went bad. This is where Silicon Valley Bank went bad. Signature Republic Bank went bad. And again, those are signposts, by the way, that the cycles are completing. So you can see this. So this is where this was happening. And then lo and behold, we get into an election year. And right here, January 1st, we're coming down. We're coming down. This is 22. You understand we peaked right here. And we're removing liquidity. We're removing liquidity. And right here, we get into January 1 of 2024, an election year. And all of a sudden, we start getting some liquidity put in. And if you notice, the stock market has picked up. The bond market has picked up. We've seen that rates have come down. We've seen that business is just a little a little better. Things are better, but that's because the liquidity got put in. Now, the election's over. That liquidity is going to come out. We have an enormous amount of debt that needs to be resolved. How are they going to resolve the debt? How are they going to resolve the debt? How is that going to happen? Well, I'll tell you how that's going to happen. We're going to have massive defaults. That is going to cure the affordability problem. It's going to cure the debt problem because we're going to destroy debt like crazy. It's coming. Let me go to my next slide. Let's just start talking about this. Let me open it up a little bit or a bit bigger so you can see this. And let me go to the next one and we'll take a look. Now, as you know, I've been not working with Charles Nenner, but I've been interviewing him for 15 or 20 years. We did a video in November of 2020 saying that the interest rate cycle of 40 years had finished right here. Charles Nenner nailed it, and it was exactly correct. And since then, rates have come up significantly. Now, rates determine how the momentum of the cycle, and these are slowing down. So the momentum for the real estate cycle, the business cycle, the stock cycle are all slowing down. And this is absolute destruction of the bond market. So when you see this huge drop of interest rates, now we've got this big one. This destroys a bond portfolio. So the bond bubble has burst, and we're going to the next one. Now, do you understand that? The bond market, which was really in this huge, enormous bubble. I mean, we got down to what, 0.65% for a 10-year treasury? One of the safest investments in the world is only yielding 0.65, not even 1%. That's over with. So when you raise it up today, I think we're currently at almost 4.5%. Just think of the losses that's incurred, because a lot of the banks had to have treasuries as collateral, and that's considered safe. That's what happened to Silicon Valley Bank. They bought these treasuries to use as collateral, to use as their reserves, and then interest rates went up. It just destroyed their collateral. So bond market has burst, and it's going south. Let me go to my next slide. Let's just talk about that. Now, I'm in the real estate business. People are saying, well, the housing isn't affected. Housing hasn't done much. Well, look at here. Commercial peaked Q4 of 2021. You have to know that commercial is in enormous trouble everywhere around the world. We've had this. We had the COVID, where people are no longer going to the office. Well, they no longer go to the office. So no one needs to rent these places. And if there's no rent coming in, what does a commercial building valued at? Is only by what it generates as income for the owners. And if there's no income coming in, there is no value to that property. And you can see we peaked. There's two peaks. There's the classic two peaks of a commercial cycle completing here. And that second peak completed Q4 of 2021. 2021, 3 years ago, this thing completed, and you can see what happened. You can just see the direction. It just came down like a drop, like a rock, and it's continued to come down and continued to come down. Now, Ken McElroy, what a smart guy. He knows the cycle. He quit buying, but now he's buying because he just purchased a property in Nevada that was on the market, was appraised at $140 million. 2 years later, he buys it for $92 million, almost a $50 million discount. He's buying it below replacement cost. Now, this is what happened to us in the great financial crisis. That's why I'm telling you, it's just like the financial crisis. In 2009 and 2010, I was buying properties below cost. Below cost. Now, you remember, Phoenix wasn't like it is now. Phoenix was a construction town. All the construction people left. Construction stopped, and business just was terrible. We were the poster child for very bad business. We're not this way. So we're not going to be, we're not going to be the bad ones. There are going to be places around the country that are. But we were buying properties in Phoenix Metro for $50 a square foot, buying 1,500 square foot homes for $75,000. And that was right about the cost of what the lot cost, and the building came free. It was just a free for all. It was just a wonderful time. That is coming. And I'm going to tell you, I own 2 properties in Scottsdale. One we sold for like $350 or so, and the mortgage payment was $3,200 a month. We rented the exact building. They were right next door to each other. $3,200 to buy it, and we rented it for $1,495. $1,700 differential. And when I saw that differential, I said, I've got to sell it. And when we were building a house, so I just bought this house for a place to live while we were building and made some money on it. And we sold it. And huge differential. We're seeing that now. So it's way more expensive for you to own than to buy. Now, there's a lot of advantages to owning, but they have to outweigh the advantages to renting. And we've seen it that it is so far out of whack. There is something definitely wrong. Fits right into our timing model. Fits just into our timing model. Let me go to my next slide here. Let's open this up a little bit so you can see exactly what we're talking about here in commercial. So Ken McElroy, very smart guy, made a very, very good deal. Cash flows immediately when he first gets in, and he's got some built-in equity. What a smart guy. And remember, he watched this thing come down. He saw it peak. If you follow him on YouTube, you can see that he saw it peak. He quit buying. He saw it keep coming down, and now it's come down to something that is worthwhile. But it's dropped enormously. People are going to take enormous. So the people who originally bought them are going to take losses, and he's going to come in and he's going to buy them at a very good price. Now, here we are. This is my model. We've been using this for a very long time. People say, well, it's housing, and housing just hasn't done much. But this is a real estate model. It's not a housing model. It's the real estate model. Commercial is already underway. Commercial is part of the real estate cycle, and it is already underway. It's starting to complete. And so when you start thinking of housing, which is where we're buying a lot of single family homes, we buy in that affordable housing space. Well, I'm really concerned because I think it's way too high. We're way up here. We're at the top. Now, this is a process. This is not a point in time. It's a process. This typically takes about 2 years, and we're getting to the end of that 2 years, and then it comes down. So real estate is in a bull market 14 years. You can't hardly, once this goes into the bull market, you can't hardly make a mistake because it goes up for 14 years. But then when it gets to this point, it comes down for 4. So now we're really concerned that we're heading it down this side. Now, it doesn't necessarily mean this is going to happen. And remember, real estate is regional. Some regions are really, really strong. Like here in Metro Phoenix, we've got all these chip manufacturers. We've got a lot of high tech coming here. And we're right next door to California, where California is losing people. We're gaining. So it's their loss is our gain. So it's going to be cushioned here. We're not going to be immune, but it's cushioned. And I'm going to tell you, there's some startling things. So this is what my model is telling me, is that we are looking for debt destruction, capital destruction on a pretty major. Now, that would resolve the debt bubble. I'll tell you that. So now this is simple. This is not definitive. This is simple. So rent should equal own. So what you pay on your rental payment should be about what you would cost for you to buy a house. You want a standard FHA. Now, they're not equal to this because, when you buy, you do have to put a down payment, typically 3.5%, but then you got closing costs, which another 1.5%. So you got 5% down total. Then you've got cost of, something breaks, you've got to fix it, you've got to repair this, you've got to take care of it. And you get some benefits from that. So you get some tax deductions. So rent to own, rent, you don't have to repair, and there's no down payment. You're not putting your credit, on the line. If it defaults, it doesn't go against your credit. You just, you have, after your year, if you decide you want to leave, you can just leave. There's no ramifications. Not necessarily so for an owner. And of course, if you own these, it's reasonably expensive to sell. So normally rent over owning would equal 1. Well, today it's going to cost you about 6.5% to buy. So that means it costs you $6.32 per $1,000, and it would be for a 30-year fixed rate mortgage. And here in Phoenix, the median rental is between $1,900 and $2,100. So $2,000 would be right in the middle of that. It's median now, not average. We try and use median because average can get really, really thrown off. I mean, you have a whole lot of people. That's what I think is happening with a lot of the indexes around, because an index is an average, and I use a median sales price, and the median sales price in Phoenix, excuse me, is 448. So the median mortgage payment. Now look at this is where this rubber meets the road. That's the problem. The median mortgage payment is between $3,000 and $3,200. So if we say the median here is $2,000 a month, this would be $3,100. It's $1,100 more to buy a property than to rent it. Now, this is where it gets startling. So if you just plug in the numbers, 2,000 over 3,100 points puts us here in Phoenix. In Phoenix, one of the great markets of the United States, is over 32% overpriced. That is a scary number. That is a scary number. Now, during the great financial crisis, some of our stuff was when we did the rent to own. Now, this is not a definitive. We can't say, oh, hang your hat, this is absolute, because this is kind of a guidepost, but it fits right into the model. This is the scary part, is it fits right into the model. So during the great financial crisis, we were even a little higher than this. We were like 40 to maybe 45% on some of our properties on the rent to own, and it just dropped like a rock. You know what happened in Phoenix in 2009 and 2010? It was just a bloodbath here. So if you take the average median price home, I shouldn't say average, a median price home with a 32% overprice, that means that for a $448,000 median price home is $144,000 overpriced. Now, if we just confirm that by saying, well, okay, so we've got $1,100 payment differential. Well, how many thousands does that $1,100 pay? So how much lower would the mortgage have to be to equal what the rent is? And this is where it gets scary. This is where it gets really, really, really scary. It comes down to $1,100 at 632 is $174,000 overpriced here in Phoenix, Arizona, for the average house. $174,000. So do you get this? That is a pretty drastic number. This is why we've been saying that timing is absolutely mandatory. Now, we here, my job is to make sure that you make money. We saw liquidity, we saw interest rates, and we saw our timing models. All three of these cycles peaked, like second quarter of 2022. So I quit buying properties, new properties. We quit putting new capital in. Now, we did 1031 exchanges because I think that's really smart. That's already seasoned money. They're going up with inflation. So there's not that great of a differential to them, and it's already at risk. So a lot of people are bailing out of Seattle and Portland and LA and, San Diego and Milwaukee and, Minnesota, all our endangered cities, selling there on a 1031 exchange and coming here and replacing properties. That was a good deal. And we quit putting new capital in. But I'm going to tell you, we are already seeing that people are coming to us that want us to manage properties. We call those orphaned landlords. They're accidental landlords, and people that can't sell their home. So we've got a couple of instances where people purchase properties in the fourth quarter of 2022. 6 months after we quit buying, they put new capital in, and they cannot sell it because they owe more on it than what they can sell it for. And the payment is really high. They can't rent it for what the rental is because they're underwater on both the payment and on the mortgage. And this is just something they bought in 2022, fourth quarter 2022. So it's validating. So this is coming. Phoenix is not going to be anywhere near as impacted as some of the places around the country, but it is going to be impacted. So let me go to my next slide. Let's just talk about what you can do and what we see. So we expect you to be patient. The most difficult thing for an investor is to be patient, and we are going to make a fortune. We are just going to make it. It's coming. I think our timing model, if you want to, we talk about coming and seeing us. We'll sit down and go over when we think it is, what we need to do. We'll get you set up for this, and we'll all make some money together. I think it's coming. We're gonna make generational money. We're gonna make money that you don't get a chance to do. But maybe 3 times in your life, and you're going to have one coming. It's going to be scary as all get out. It's just going to be really scary as all get out, because I think the economy is just going to collapse. Just me. I could be absolutely wrong. Things are pointing that way. I had some pretty good company on a lot of these things. You come talk with us, come to some of our conferences, and we'll go over this with you. If you need to reach me, you've got my number. My very best to you guys. Bye-bye now.